right, well, hello everyone. I'm happy to be here today to talk to you about homeownership and specifically about affordability. And I'm hoping you'll take away some information that is useful to you, specifically in regards to what is considered an affordable house payment. I'm also hoping that after today, you'll understand how lenders qualify a borrower for a mortgage, and that you also understand some basic information about mortgage types. So the first thing we want to talk about is what is affordable. And there's actually standards that are out in the industry that determine that a house payment is affordable. I also like to think about when we're looking at a mortgage and whether it's affordable, I like to think about whether it's sustainable, meaning that it'll be sustainable to the household over the long term, that you'll be able to continue to make that payment through a variety of changes that occur in your personal finances throughout the years. And before we talk about what's considered affordable, let's establish the difference between pre-qualifying and receiving pre-approval on a mortgage. So pre-qualify versus pre-approval. Pre-qualification is an informal assessment of the consumer's credit worthiness, and it provides an estimate of what may be borrowed. It is only based on the information that the borrower provides to the lender. No application is collected, income isn't verified, and credit scores are not checked. It really is just the lender's best guess. It's just an estimate. Pre-approval happens after the borrower completes a loan application. A credit report will be ordered, an interest rate will be quoted along with a specific loan type. The borrower is pre-approved based on verified information. When we are considering what is affordable, it helps us to know what a lender will base their decisions on. Lenders usually look at a variety of factors regarding your financial situation, and they will use this information to determine whether they will lend you money. We call this the 4 C's of credit. You'll see that there are 4 C's here. We have capacity, capital, credit, and collateral. Capacity is looking at your income and the affordability of a potential payment. So questions they're asking under capacity are, do you have adequate income to make the loan payment? What percentage of your income is already going to debt payments? Next, we have capital. This is looking at what cash and assets you have. They're looking at whether you have reserves that will allow you to make the payment in the future, especially if there was a decrease in your income. So do you have reserves and savings that you could make that payment for a couple months if your income was to decrease? They're also looking at, do you have the money to pay for loan costs, such as a down payment and closing costs? Third, we have credit. This is where we're looking at your credit history and your credit score. These things tell the lender whether you can be trusted to pay the money back. It's looking at your trustworthiness. Do you make your payments on time right now? Are you using a high ratio of credit? These are all things that the lender is analyzing when they look at your loan application. Finally, there's collateral. With collateral, they're looking at the property and evaluating whether the value is enough to secure the loan. So the lender will do an appraisal. They're interested to see if this home will appraise for the same amount that you're borrowing. And they're also often looking at the property condition, especially with government insured loans like FHA. There will be an inspection of sorts to make sure the house is structurally sound. Because this is an investment for the lender, they want to make sure that this is a good investment for them, a property that could be resold if they needed to do that. So it's important to notice that not only do you qualify for the mortgage, but the property must also qualify for the mortgage. When a lender is pre-approving a borrower, they will look at the capacity, the capital, and the credit together. These factors will give a pre-approval amount. Once a property is chosen, the lender will look at all the factors, capacity, capital, credit, and collateral. And this will determine whether the mortgage will be approved. Again, just a reminder that the property must qualify just like you, the borrower, need to qualify for the loan. Okay, before we continue on with affordability, I just want to bring up something that Mackenzie talked to you about last week, just a side note, that once a mortgage loan application has been submitted, the lender must provide the borrower with this loan estimate. This is a legal requirement. The estimate must be given within 3 days of applying for the loan. This loan estimate is really helpful in comparing mortgages because it gives you the loan type, the loan amount, the interest rate, the term, the monthly payment, closing costs, taxes, other costs, basically everything you need to know about this loan to know if it's a good decision for you. You will need to sign this loan estimate. When you sign it, you're not stating that you want the loan, you're not committing to the loan, you're just indicating that you've received this estimate. It is also not a commitment from your from your lender to lend to you. It's just putting all of the information on the table so you can make a wise decision as a consumer. You will need to tell the lender that you intend to proceed with the loan, and you usually have about 10 days to do that. Christy will share the loan estimate. There's a really good loan estimate that Mackenzie shared last week, but if you didn't have a chance to look at it, Christy can share this link in the chat. And I really like this loan estimate because you can go through and you can hover over each item and it will tell you what that item is and what you should be looking for. All right. So coming back to the 4 C's of credit, you will notice that capacity is based on income and affordability. And that's what we're here to talk about, is affordability. Affordability in regards to housing is based on ratios. The lender will use ratios to determine how much a consumer can borrow. They often use 2 different ratios, the housing ratio and the debt to income ratio. The housing ratio is only considering the actual house payment. The debt to income ratio is taking into account all of the debt payments that a household has, including the mortgage and all consumer debt. The housing ratio, also referred to as the front end ratio, is usually about 30%. Specific ratios will vary by loan type, but that 30% is an industry standard. Whether you're renting or buying, it is recommended that the payment you pay for your housing hovers around that 30% ratio. 30% is considered an affordable payment for housing. With FHA loans, the front end ratio or the housing ratio is usually about 31%, and the conventional ratio is typically 28%. Next, we have the debt to income ratio. Like I said, this includes your house payment and any debt payments that you have monthly on consumer loans, such as car or truck loans, credit cards, student loans, any debt payments that you have. An affordable debt ratio is usually around 40%. And with these different loan products, an FHA ratio is typically 43%, and a conventional loan is typically 36%. So if you read about ratios, you'll hear FHA 31-43. 31 refers to the housing ratio, 43 refers to the debt to income ratio. So these ratios are standard ratios. They're just pretty standard in the industry. However, lenders sometimes stretch these ratios to accommodate borrowers. They may do it based on creditworthiness. Like if you have really good credit history and it looks like because you've paid well in the past, you could handle a higher ratio, that you'll make it work for yourself. They may extend them in that case. They may also extend them if you're purchasing an energy efficient home. And Christy's going to share in the chat a link to EnergyStar.gov, and that tells you more about energy efficient mortgages. Energy efficient mortgages, they have higher, more lenient ratios because the assumption is that because you're spending less on your utilities, because this is an energy efficient home, that you'll be able to afford a higher house payment because there's just less money going to utilities. So that money can be used to make the house payment. So in some cases, extended ratios could benefit borrowers. For example, a borrower with a good credit score who lives in an area with high priced houses, that could be beneficial to them because they couldn't afford a home otherwise. So those ratios would be extended to allow them to afford more house. Also, like I said, with this energy efficient home, the savings in utilities is offsetting that housing cost. Often when ratios are extended, lenders may have stricter requirements like a higher credit score, more cash reserves, or a higher down payment. The most important thing to consider when we're evaluating affordability is that we consult the budget. I know that's not a word everybody likes to hear, but it really is important because that tells us about your living patterns and your spending habits. And the budget will really tell you whether a payment is affordable. So I want to show you two households. From a lender standpoint, these households look the same. They have the same income. They have the same credit score. They have the same monthly debt payments. A lender will view both families equally. The lender will qualify them for the same house payment. However, if we look at these families, we'll see that their budget tells us a different story. With the first household, the children participate in a variety of lessons and activities. The family eats out regularly, and they also enjoy season tickets to their favorite amusement park or sports event. So you'll see that their activities, entertainment, eating out budget is a lot higher. Now, if we look at household two, the children participate in activities that have minimal cost. The family enjoys free or low cost activities when they are together. The living patterns and expenses are different for these two families. When we look at the budget, we see that their entertainment, eating out, activities section of their budget is much lower for household two. Neither scenario is better than the other. So in these instances, like I said, a lender will say that a certain payment is affordable, and that may be true. Yet it's also important to consider what else you want to do and how that will affect the affordability of your mortgage. So with this point, we can see why it is so important that we always consult our budget when we're taking on new debt payments. A good question to ask yourself is, what do I want to do beyond buying a home? And I don't know if this might be a good time for you guys to chat amongst each other, amongst yourselves in the chat, and think about things that might affect the affordability of a mortgage for you. Also, you may want to do certain things, but then there's other things you might be willing to let go so you can afford a higher house payment. All right, let's go back to ratios and let's talk about how to calculate those. So when we're calculating a ratio, we're taking a number and timesing it by a percentage. So for our example, we have a household that has a $60,000 income per year. And when we divide that by 12, we find that they earn $5,000 per month. This household has $650 that they're paying in monthly debt payments. And for this example, we're going to use the FHA ratios of 31 and 43. So first, we calculate the housing ratio. we take the gross monthly income times the housing ratio, and we get a potential payment. So we're calculating two ratios, which is going to give us two different payments. We always take the lesser of the two. So on the housing ratio in this example, we take 5,000, we times it by the percentage 31, and we get 1,550. So that is saying that just the house payment alone is affordable if it's $1,550 or less. Now we need to calculate the debt to income ratio. With the debt to income ratio, we take the gross monthly income, we times it by the ratio that's allotted for debt payments. So in this case, that's 43 or 43%. When we do that, it gives us 2,150. Now remember, this is a debt to income ratio. So we need to subtract out the debt payments. Let me look at the example. So when we subtract out the debt payments of $650 from that first calculation, we get a house payment of $1,500. Like I said, we take the lesser of the two. So that tells us that the payment should be $1,500. With this household, their income and these ratios, an affordable payment is $1,500. Okay, so I just want to go through that again, just to give you the ratios, because this is something you can do on your own. You can either use those standard ratios of 30, 40, or you can find out ratios for the loan product you're interested in, and you can calculate these ratios for yourself. So just as a reminder, the housing ratio is your gross monthly income times the housing ratio, or the front end ratio, and that gives you a potential payment. The debt to income ratio is your gross monthly income times the debt to income ratio minus your debt payments, and that gives you a potential payment. Again, we take the lesser of the two. Next week, we will be talking about what makes up a payment, but I want to give you a little preview so you can use this information between now and then. Payments are made up of PI, TIA. The first PI stands for principal and interest. That portion of your payment is paying just the principal and interest of the loan. The TIA is property taxes, any insurances, and your homeowners association dues. The TIA usually makes up about 20% of the payment. So when we do these calculations for affordability, we would subtract out that 20%. So on that $1,500 payment, we would actually subtract out $300 and know that the principal interest portion should only be $1,200. So when we look at online calculators, we might do that for fun to see, oh, if I bought this house, how much would my payment be? You need to keep in mind that those calculators are giving you just the PI portion. So if an online calculator says that the payment is going to be $1,200, we need to add another 20% to get a full payment amount. So that $1,200 payment will actually be a $1,440 payment. So when we're practicing in our budget, we want to make sure we're planning for the $1,400, not the $1,200. Now that you know how to calculate ratios, you can use those formulas to calculate a payment for any loan product that you know the ratios for. If you don't know the ratios, you could base your calculations on the standards of 30, 40. And so in this example, we have $60,000 gross annual income, $5,000 monthly income. We times the gross monthly income by the front end ratio, and we get $1,500. We times for the back end ratio, we take the gross monthly income, times it by 0.40 or 40%, we get $2,000. We minus the debt payments, and that gives us $1,800. Now, you've probably noticed that the debt is taken into consideration when ratios are calculated. Hopefully, this has helped you realize that your debt will impact your eligibility for a mortgage. So let's look at an example. Two households with the same income of $50,000 and a monthly income of $4,167. The first household has no debt payments. The second household has $700 in monthly debt payments. When we calculate the ratios for household one, we get a suggested payment of $1,291. When we calculate the ratios for the second household, we get a house payment of $1,091. Because household one has less debt, they are able to qualify for a higher loan payment. All right, so let's do a recap. I feel like that's a lot of information really fast. Let's do a recap of what we've talked about so far. First, lenders use the 4 C's of credit to qualify a borrower for a mortgage. The 4 C's of credit are capacity, capital, credit, and collateral. We also need to remember that lenders use ratios to qualify borrowers for a mortgage. And an affordable house payment is approximately 30% of a household's gross monthly income. Debt payments below 40% of a household's gross monthly income is also considered affordable. In order to calculate a housing ratio, we need to remember the formula of timesing our gross monthly income by the housing ratio. And to calculate the debt to income ratio, we take the gross monthly income, times it by the debt to income ratio, minus the monthly debt payments, and that gives us a potential payment. We always take the lesser of the two, and it's very important to consider how this payment will fit into your budget. Now, sometimes when people calculate these ratios, they're not very happy with the numbers that they calculate. If you are unhappy with the payments you calculated, or if you feel like homeownership is unattainable, remember that in personal finance, the solutions to our financial concerns often revolve around reducing expenses and or increasing our income. On this slide, I've given you some ideas of how to do those two things. So first, keep in mind that debts with 10 months or less of payments will not be counted in these calculations. So if you have 10 months or less left on a loan and you apply for a mortgage, your lender will not include that in your debt to income ratio. Another option is to consolidate your debt so you only have one payment. This can be tricky though, so you want to make sure you evaluate all of your options carefully and that you thoroughly research it. It's also important to remember that you don't take on any additional debt. That is one thing that people will do when they consolidate their debt. Because the debt has been consolidated and the payment is different, they feel free, so then they take on more debt. So that's kind of a cautionary idea. Another idea is to extend your loans, like an auto loan, extend it out so you have smaller monthly payments. It's not really changing your overall indebtedness because you'll still owe the same amount, but it would change your debt to income ratio because you have a smaller payment. You can also increase your income. This could be taking on a second job. You could have another household member take a job. You could also ask for a raise from your employer, or you could even consider changing your employment to something that pays better. You could increase your savings. That would allow you to put down a larger down payment, so you wouldn't have to borrow as much. It would also mean you would have, because you're borrowing less for the mortgage, you would have a smaller monthly payment. Another idea is to pay off debt with your extra money. like your stimulus payments or your tax returns. When you're preparing to buy a home, this is a good time to check your credit report and make sure it's accurate. During the pandemic, you're allowed to check your credit report for free once a week. The credit report won't show you a credit score, but it will show you if there's inaccurate information, such as accounts that aren't yours, or inaccurate reporting of payments. It also gives you the opportunity to see if anything is delinquent, and you can become aware of what is on your credit report. And then, of course, you can dispute any inaccurate information. Another idea is to make sure you're keeping a stable employment history. So it's not necessarily the time to change careers. I know I just said you could change jobs to get higher pay, and so you just have to evaluate which choice was better for you. But it is important that you've stayed in the industry. So for example, it's not a great time to leave a steady job that you have a regular payment and to become self-employed when you're trying to buy a home. Do that later when you're not trying to qualify for a mortgage. Wait it out if that's something you really want to do. That's what I'm trying to show you here. It's also important that you plan your mortgage loan shopping. So when you apply for several mortgages within a 2-week time period, it only counts as one inquiry. But if you drag it out over a longer period, you'll end up damaging your credit score. So that could result in a lower interest rate than a higher interest rate than you were hoping for, because your credit score has been damaged. And then of course your credit score will be lower. And so you wouldn't be able to qualify for the best loan product. And then finally, like Mackenzie talked about last week, make sure you season the money that you plan to use for the home purchase. So if you're saving money in the mattress, get it in a bank account. If you're planning to use money that is gifted, make sure that that's been documented, that it's in the person who's gifting you the money, that it's been in their account and it's been seasoned. We don't want money just coming from nowhere. Lenders can't accept that. So make sure you are seasoning the money. Okay, the final thing I want to talk to you about is loan types. Your mortgage lender is going to be aware of all of the options that are available to you. So it's important to choose a lender who you work well with. You want to interview them because they are working for you. You want to make sure that they're willing to answer your questions and not pressure you, and that they really are advising you which loan product is best in your situation. To get started, here's some basics about different loans. You will notice that I've also provided the typical qualifying ratios so you can do calculations like I taught you today. So first, let's start with FHA. FHA is a federally insured loan program. Because it's federally insured, we often see that they have more lenient qualifying criteria. Mortgage insurance will be required for the life of the loan if you don't have a 20% down payment. And the only way to get rid of that mortgage insurance is if you were to refinance. The loan to value requirement is 96.5%. That means you can only borrow 96.5% of the home price. So you would need a 3.5% down payment. Next is conventional. They are sometimes a little more strict because they require a little bit better credit scores, a little bit higher down payment. The ratios are typically 28-36. However, they have written loans with a debt to income ratio as high as 50%. So again, just remember, if you're looking at a higher debt to income ratio, make sure it's affordable to you and realize that there may be other criteria that you need to meet in order to get that extended ratio. Down payments will vary in this loan. They could require 5%, 10%, 20%. If you put 20% down, you avoid mortgage insurance. And with conventional, the mortgage insurance can be removed at 20% equity. And usually you'll just request for that to be taken off. However, it automatically comes off at 22% equity. So if you're getting close to 20% equity, you want to watch that so you don't have to pay mortgage insurance any longer than you really need to. Another popular option is USDA financing. They offer 100% financing, so there's typically no down payment. The catch is that you have to purchase in a rural area. And from my reading, I noticed that a rural area is considered a population of 33,000 or less. It often does have an upfront funding fee and an annual fee that acts as mortgage insurance. Borrowers usually need to meet income qualifications, and this loan actually offers a 33-year repayment term. So instead of extending the loan over 30 years, they actually give you 33 years to pay the mortgage back, which will make the payments just a little bit lower. There are a couple different types of USDA loans. So depending on the type you receive and where you receive the loan at, you actually may qualify for a subsidized interest rate, meaning that the interest rate will be reduced a little bit, and so it makes the payment more affordable. There's no mortgage insurance, but like I said, there's an upfront and annual mortgage guarantee fee. This fee usually goes away with 20% equity. VA loans are specific for veterans and service members. Not everyone who has served in the armed forces will qualify. There are requirements that are based on the length and type of service. A borrower would need to obtain a certificate of eligibility. There isn't a down payment. However, borrowers are often assessed a funding fee. This fee is based on your down payment and whether you've used a VA loan before and how you've used a VA loan. There's no PMI, and there's typically just a debt to income ratio. Finally, some of us may need to purchase in an area where we need to borrow more than what's allowed in these other options. Most of these lending options have lending limits. And so if you need to borrow more than what the lending limits allow under these other mortgages, you might consider a jumbo loan. They have higher lending limits. However, they have stricter qualifying criteria. Because it's more risk, because you're borrowing more money, rates could also be higher. When you're deciding which mortgage is best for you, it's a good idea to consult a lender and compare offers from 3 different lenders. Comparison shopping helps you get a feel for the market and to see what is available in the market. It's also important that you calculate your ratios and see what's affordable to you and whether it fits into your budget. You can compare your calculations to online calculators. We also have in our group that provides homebuyer education, we have a housing affordability worksheet. This is a worksheet that we use in our courses, and I've provided a copy to the EFW team today that they'll be sharing with you. I've received this copy from our partner, Utah State University Housing and Financial Counseling. And this worksheet actually walks you through all of those ratios that I've explained. Plus, it tells you how you can figure out how that payment translates into a mortgage amount. And you just would need a little bit of information about the loan that you're interested in. But I've provided you these ratios today. So with those ratios and just a little bit of information about the down payment requirements of a specific loan, you could actually use this to run a bunch of scenarios for your personal situation. Again, this will be emailed to you after our webinar today. That sums up everything I have to teach you today. I hope this information has been helpful. I appreciate you joining me. I'd like to take a moment to answer any questions that you have or any that Christy feels like we need to answer more thoroughly.
We don't have any questions in the chat, Stacy. So if anyone else has one they want to just ask.
Okay, if we don't have any more questions, like Stacy said, we're happy that you joined us today. Thank you for joining us. We'd love to hear your feedback. If you can just go to the link that Kirsty just put in the chat, or scan this QR code on the screen right now. It will take you to that survey. And if you take that survey, you'll be entered for a drawing. We'll pick a winner at the end of the month. We have one more webinar, right? Next week, or right, one more. We have one more next week. We hope that you could join us again. If you are not joining us on social media yet, if you're not following us yet, give us a follow. We're on Facebook, we're on Instagram at Utah Money Moms. Join us on the blog. We have a lot of housing articles this month from our team and from Stacy and from Mackenzie. Visit us at utahmoneymoms.com. You can register for more of our webinars on finance.usu.edu/EFW. You can also host a class for free. You could go to that same website, and there will be a link there that will take you to an intake form, and we could start communicating with each other, and we could figure something out, how to bring the resources to you. We'll bring the materials, we'll bring our expertise, you bring your friends, you bring your families, you bring your neighbors, and we'll have a good time together. If you have any more questions, you can put it in the chat, but otherwise, we are happy that you're here. We thank you for joining us today, and we hope that you have a great rest of your day. Thanks, everybody.